hot day. It is an incredibly hot day today. So I know that you might not be actually watching this live today. I know you might be out enjoying the sun, or maybe you are. Maybe you're out there with a glass of wine, enjoying the sun, and listening to me talk to you about your money matters. So we've got some people saying hello already on YouTube. We've got Eileen, and we've got a few more people there. Do say hello, guys. We've got Blue Flower Ninja, we've got Abdullah, we've got Lily, we've got Mock, we've got Rafaniet, we've got My Life over on Instagram. Nice to see you guys. Hello to Tina as well. So what I'm going to try and do with this, as we always do, is I will try and answer your money questions. I will try and help you with those queries you've got. Now, a lot of the time, I know we tend to focus on things like bank accounts, savings accounts, current accounts, credit cards, all that kind of stuff. That is all great as well, but just fire them at me. If I can help, I will. I also like to ask you guys a question as well. I'd like to hear from you. And on the back of an article and a video I did this week about Triodos, which is regarded as like the most ethical current account out there, I kind of want to know whether this is something that you guys think about. Are you worried about where your money sits? So do just like say hello, let me know who you are, and let me know if this is something that you do think about. Actually, you already asked this over in the community on YouTube just a couple of days ago, maybe just yesterday. Had about 150 votes so far, which is great. About a quarter of you said yes, you do want your money used for positive change, so it's important where your money sits. The biggest chunk of you, 55%, so more than half, basically you just want the best rewards and rates, which is totally understandable when things are so tight right now and interest rates are so poor, just trying to get as much as you can. But a decent chunk of you, 18%, also said they didn't know this was a thing. They didn't know that your money, when it is in your current account, in your savings account, or your pensions, your investments, or whatever it is being used for things that you might not necessarily correlate with your own values or things you're trying to do in the rest of your life. So do let me know, say hello, let me know what you think on those matters. Is it something that matters to you? Got a question on from Abdallah on Instagram. Any advice on how to repay uni fees? Does it affect your credit score? So student loans is the initial one. So this is quite a complicated one, and it depends what country you're in, when you went to university, all these sort of things. So it's going to be quite a general answer. It's definitely worth researching this a bit more. I don't have to hand the figures to kind of say exactly how much money, what you have to earn to pay them back. But essentially with student loans, this is something that you see a lot of people, Martin Lewis, for example, taking the line that using the word loan is kind of a mistake, because it's not a debt in the same way that a credit card or a loan, a normal sort of personal loan, or even your mortgage or anything like that would be, because you're only going to start paying back your student loan when you earn a certain amount of money. So actually it's probably more of a graduate tax, and that's often seen as maybe a better way to think of it. Okay, so if you have a student loan, don't think of it in the same way as any other money you owe to somebody else. Okay, think of it slightly separate. You will only pay that back when you earn a certain amount. So before that, on the whole, it's probably not worth trying to overpay it early, particularly because after a certain amount of time, it can wipe itself out. So you don't end up, potentially, a lot of people might not pay it back at all, or even pay back the full amount. If you're going to be a high earner, and if you're high earning from early days, then that might be slightly different. So I wouldn't worry about that too much. Obviously, if you are earning above the threshold where you do start paying it back, it gets a bit frustrating because you're going to have even less money, disposable income available to you. So I would say then, okay, it's coming out, you need to budget for that, and you have to pay, you've got no choice. But it wouldn't affect your credit score or anything like that. Potentially it could come into play if you're looking for like a mortgage or something, because it would come into sort of the disposable income element, like how much money have you actually got available to you to make those mortgage repayments. But I wouldn't worry it too much about it in terms of credit score, Abdallah. So it's annoying. I know it can be a huge amount of money for people, particularly if they've also gone past that normal graduate degree onto, the normal undergraduate degree onto masters, PhDs, whatever it might be. They can really rack up the costs. But wouldn't say put it off anyone going to university, but on that basis, really investigate it properly. Don't just think I can't afford to have all that debt, because obviously you will have student loans off the back of that as well, potentially to pay back. But yeah, definitely have a think of it that way. So we've got a question from Eileen on YouTube. It says, hi Andy, on ISAs, who pays the best rate? Lloyds are only paying 0.01%. Should I move them, or are they all paying the same? So absolutely, what I would say is you should move it, because you can get a lot better, or say a lot better. You can get much better than 0.01%. When you are looking to move ISA, money in a cash ISA, something really, really important you have to look in for. You have to look for a new ISA account that would accept transfers in. Okay, so look for that wording. Will they accept transfers in? Because if you just took the money out of that ISA and then paid it into a new ISA, like you would if you were, or just transfer, you would think an obvious thing to do. You're actually using part of your annual allowance. Now, with an ISA, every year we get £20,000 we can put into any combination of ISAs. So it could be a cash ISA, it could be a stocks and shares ISA, lifetime ISA, not junior ISA, innovative finance ISA. Junior ISAs are separate. They're not part of that annual allowance. So they're not for adults. You've got that £20,000 allowance. So let's say you've got 20k in an ISA. Let's say you've got 40k in an ISA. You take that money out and pay it into a new one. You've just eaten up your allowance. And if it's above 20k you can't top that up. You have to wait for the new financial year. But if you transfer it to an ISA that allows transfers in, reiterate that, how important that is, it doesn't impact your allowance. You're just moving it across. So you still get your allowance from that year to top it up again. So make sure you look for that. The best right now, from the top of my head, and it could have changed because I haven't checked the rates today actually, so it could have changed today or yesterday. You can get 0.54%, I believe, at Kent Reliance, and Marcus was offering 0.5%. Although, however, I'm not 100% sure that either of them allow transfers in. But I will have a look. I'll update. I've got a guide to all the best savings accounts over on becleverwithyourcash.com. So when this finishes, I'll have a quick look and just make sure what the best paying one is for transfers in for you. But absolutely, you can beat 0.01%. Even if you get 0.4%, you're getting a lot more there. Loads more people just joining in here. So hello to all of you guys. Hello to Roberto, to My Life. Hi to Beat Baby, to Weekend Bakery, and to Sidhu, to Dilts, to Alex, to Tim. Nice to see you guys. So Blue Flowers has asked me, Vitality Health Insurance, do you have any private medical cover? So I guess you're asking, what do I think of private medical cover? So this is an interesting one. Yes, I do have private medical cover. I had it through my various employers in the past. Obviously, now I am self-employed. I've carried on paying for it. And it isn't cheap. And the older you get, the more expensive it gets. So it's a really tough one to weigh up. Essentially, the benefits of health insurance are that if you were to get very, very, very sick and you needed immediate care, and I mean, COVID has obviously had a huge amount of pressure on the NHS, which was already struggling from underfunding, that it might be that even now those waiting lists are even longer. Whereas if you have private health insurance, you will hopefully get treated far, far, far quicker. And sometimes you get an appointment within days, at least for that initial consultation. So you're paying for that. You're paying essentially to jump the queue. Now, not everyone would agree with that, but in a way, it sort of frees you up because you're not on the NHS waiting to see us. There's more space for other people there. In terms of which one's best, there will be comparison sites, I'm sure, that will give you all the different prices and let you know what you're going to get for your money. I mean, really, you're looking at the cover. This is the same with all insurance. Just because something is cheaper than the other doesn't mean it's a better option, because you might be missing something that's really important. There might be let's say you're thinking you might want to be taking physiotherapy. There might be a limit on that, or it might not include mental health support, or it might have limitations on cancer treatment, all those kind of things. So you really need to have a look at what they offer. Now, in terms of benefits, I know that Vitality, I'm pretty sure, it does have some freebies that come with it, but don't be swayed by those. If that insurer you go for is the best one for you and you're happy with what the charge is and you're happy with the cover you're given, then have a look at what those extras are. But so with all this insurance, you want to make sure you've got the best cover. So I hope that helps you there. Tina says, still on a conference call, so I have to miss the live action. Enjoy. Thanks, Tina. Well, I'm sure you'll watch it on catch up. I love these regulars. You guys coming back every week. It's so nice to sort of continue to chat to you guys week after week. Cop and Robbo says, good evening, Andy. I love your content. Thank you. Really kind of you. I have £350 in savings. What is the best place to put it? Okay, so that's fantastic. Well done. Because I know a lot of people, you'd think, some of you watching this would be going, how have you managed 350 quid? Like, you can't even think about that. Other people are thinking, why have you only got 350 quid? But this is because everyone has different, you've got to remember this, everyone has different income, different expenses, all these sort of things going along. So to have 350 quid available to you is a really fantastic start. So well done to do that. You want it somewhere you can access it easily, right? Because if an emergency comes along, you can go to it and you can get that money out. If your credit score is decent enough and you haven't got anything big coming along, then you could look to apply for a current account with Virgin Money. Now, this will give you 2.02% on the first £1,000 you have saved. It's a fantastic account for people to have just for that kind of starting savings pot, that starting emergency savings pot, or whatever it's for, saving for a holiday or a wedding or whatever it might be, you'll struggle to beat that 2.02%. So I would go for that. And it's a standard current account. There are branches, although accessibility a bit tongue-tied there, via the account. They're still working those things out after the merger they had between Virgin Money and Yorkshire Bank and Clydesdale Bank, because they all come together under the Virgin Money brand. But if you've got the app, really easy to manage. And in fact, if your savings build up and you get more than £1,000 in there, you could open up a second account with them and again put another save up to another £1,000 in that account, and it all works fine through the app. MK Buck says, hi Andy, great channel. Thank you. I want to start investing. Can you recommend a good platform for beginners? Thank you, Alison. So as I mentioned before on these lives, I don't tend to talk in detail about investing and recommend particular products, because this isn't something that I spend a huge amount of time on in terms of knowing the whole sort of world out there. So I can tell you about savings accounts and current accounts. I know them, so I know what I'm telling you is the right thing. So what I would suggest you to do is just do a little bit of research online. Find some articles. There are some fantastic resources out there which will take you through all the different platforms. The important thing to think about when it comes to choosing your investing platform, and for those of you who don't know what this is, it's a bit like, it was a great, my friend Ryan on Instagram, what's it called? Make Money Simple? Make Money Simple, I think it is. He shared this great little thing. And this was how to think about investing, right? How to think about all these different words that you see, these new terminology. And the platform is essentially the supermarket. Think about it like that. That's where you go, the place you go to buy the things. And then below that, you've obviously got the products, you've got other things. So your platform, you've got, obviously, as with supermarkets, you've got a choice of places you go. And sometimes they sell the same product inside. Sometimes they only have very specialist products. So you've got to sort of think about that for a start. Does the platform you want to use, or the platform you're looking at, have the underlying funds, stocks, whatever it might be, bonds that you want to buy? So that's part of it. But also really, really important that you look at what the fee is. And this can be a proportion, a percentage a lot of the time. Sometimes it's fixed depending on how much money you have invested. That can really eat into it. So there are some which are very, very, very low fees. I know Vanguard, for example, has very, 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 very low fees, but it has a more limited choice of funds that you can go for, whereas others have much, much more range of places you can go to, but the fee might be a lot higher. You might also want to think about, we talked about, the question for you guys today was how important it is to you about what's happening to your money when it's in the bank or your pension or invested. Is it being used for things that go alongside or against your values? Now, when you're talking about investing and pensions, because pensions is investing, it's just under a different sort of name and sort of restrictions to it, that might be something you want to think about as well. And potentially, and I don't know enough about this, it's something that I personally need to learn more about as well. You might have to pay a little bit more in terms of accessing those fees than maybe the cheapest ones, but in the longer term, you might sort of, that might be more important to you. Let's have a quick check what else we've got over on here. So a question from Deals. If I add a partner to my Amex account as an additional card holder, will I get one statement or is it split between both of us? The main thing is one direct debit or two. So this, I've talked to you guys before about this. If you missed it, I'll just reiterate quickly what it is. You can get this with a lot of credit cards, not just American Express. It's called a supplementary card. So you open up this credit card in your name. It's your credit report that is checked. It's your income that's probably taken into account to see whether you are going to be accepted for this card. It is your card. You then add a supplementary card, which could be in your Dilt's name situation, in my situation, in your wife's name. So they have a card. So I've got it here. I've got Mr. Andrew Webb on my card, and my wife has her name on her card, and she will spend away on it for things. We use it for like shared purchases and stuff, and I'll spend away. I will get the bill. I will get that completely. She will not get any of that stuff. She'll have access to the app so she can see her transactions. She can't see my transactions. And it is one direct debit from the card holder. So you as the card holder, you are absolutely responsible for paying it and for all the money that is spent on it as well. So it is important that if you are going to do this, I think it's a great way to boost your cashback returns, particularly when there are welcome bonuses, that you do have that is very clear with the person that you are giving that supplementary card to, because they might not be as savvy as you. They might not be as fully aware of exactly what credit cards are and how they work. So make sure you have that conversation. And there is another little trick you can do where to get these American Express welcome bonuses, that if you've had a card you can't get a welcome bonus again, and these can be worth like 100 quid, 200 quid potentially, if you've had one of these reward cards in your name in the last 24 months. So what you could do, have a card in your name for 24 months and a supplementary card with your partner. Then after a year or whatever it is, or 2 years, your partner could open the card, you could have a supplementary card, and you cancel your one. So you start that 2-year period again. And every 2 years, you just jump between that. So you've got the cards, you've got the cash back, but you also get that little extra bonus, 150, 200 quid every couple of years. Right, what else we got going on here? Loads more things coming through, guys. Great to have all this coming through. Chris has said, yeah, this is a really good point from Chris as well. Talking about Eileen's question around moving her money. Your rate is so poor, you can get more in a current account to do shop around. You can easily get 0.5 to 0.6%. That's true. We're focused on the ISA there simply because if you do have large amounts of money and it's inside that kind of tax, the ISA wrapper, then you don't get charged tax on the interest you earn. Now, most people, that's not going to be a problem, even if you have a huge amount of money, because we all get to earn £1,000 a year in interest tax-free as part of our personal savings allowance. It does drop down to £500 if you are a high rate taxpayer. But if there is a lot of money that's built up over the years, you might want to keep it in there. And at the moment, those rates are comparable to the best easy access current accounts as well. Mini Mad has said, first live chat I've been able to attend. Well, thank you. It's great to have you. Always love to have you guys along. Chris has said the Yorkshire Bank ISA is a 0.25% rate, so that's better. It's definitely a better rate, but I hope you'll be able to beat that again. Elliot has said, what's your opinion on lump summing or phasing your money into an overpriced market, a 20 plus time frame? So again, this is one which I would probably go to people who are more focused on investing to give that real kind of understanding of what you would do when the markets go up and down. But I can explain what the concept is for you guys who don't know. And this is the sense that if you put all your money into an investment or into a pension, something like that, you put it all into the same time, there is the risk that you're doing that at the height of a market and suddenly it drops down. Now, over time, that will bear out, but you're losing a lot of value very quickly on a large chunk of money. Now, if you do it month by month and you kind of measure, you're kind of riding the waves, so to speak, that goes up and down, and you're less likely, it will kind of, the losses will be less severe, potentially, if they happen. It could also mean, obviously, if you put your money in when it's very low, as a lot of people did, just over a year ago when the markets really slumped when the pandemic first started, they suddenly went up a huge amount. So it's a tough one to know, but this is called a sort of a pound cost averaging, dollar cost averaging. Generally, the thought is to do this bit by bit. Of course, if you do have a lump sum that comes in, I would if it's a hefty lump sum, a decent amount, I would talk to a financial advisor and get their thoughts on this. But again, there is a huge amount of content out there online, some great articles from great places where you can get a bit more information on that, people who are been doing this for decades potentially can tell you more about that. So we've got a question here from Roberto on Instagram. Good evening. Is it better to go for a 5-year fixed rate or chance the rates improving and take a year fixed rate? So Roberto, I'm assuming you're going to be talking about savings here. There is a chance you're talking about mortgages. If it's mortgages, let me know and we'll answer that one in a second. But so fixed rate savings, what you're getting there is certainty. You know that you will get that return on your savings for that set amount of time. Problem is, once you're in a fixed rate account, you can't take it out. If you take sometimes you can't take it out at all, right? Sometimes you can take it out, but you just lose all your interest, or you lose a proportion of the interest, depending on the fix. If you're doing that for 5 years, and rates suddenly shoot up because we're seeing inflation increasing over the last few months now, we're seeing that happening worldwide. That potentially is here to stay. Potentially that would also mean that interest rates, the base rate, the Bank of England base rate will increase as well, which might, no guarantee, depending on how big it goes, see people savings accounts also see rates increase as well. Then you might find your money's locked in and you're losing in the longer term. But you will get right now, probably, I haven't got the rates in front of me, but the longer you fix for, the higher interest rate you'll get. So there's a thing, maybe it's about getting a spreadsheet out and doing your own sort of bit of maths and working out, right, if I have this amount of money in this account for 5 years at this rate, how much will I get? And then look at, right, well, what's the equivalent of 1% now? What would it have to jump to for that money to actually eat into that? And it depends obviously how much you're saving as well. So it's a really personal choice there, what you would do. Rates are so low right now, though, just generally across the board, that you can't imagine they can get too much lower. Again, we don't know that. Anything can happen, because they could do. It was still only 6 months ago, there was still the spectre of negative interest rates coming into play. So I can't tell you exactly what to do there, but I personally haven't fixed anything. And also, if you're looking longer than 5 years as well, 5 years might be a sort of a period where you might want to look at investing and putting your money in the stock market, and seeing how that goes, because historically, over time, and you can't judge past performance for future performance because everything is different. You'd hope at least to get a better return. So that might be an alternative to investigate there. Chris has said, this is replying to one of the earlier questions, investing is something I'm keen on and do it a lot if I can be of help. So a good call is something like Nutmeg, which will deal with funds for you. Good platform is Vanguard. So yes, Nutmeg is one of these robo-advisors, essentially, where you just choose your level of risk and it kind of gets done for you. You don't even have to pick funds. You don't even get too complicated at all. It can be very, very, very simple. Mini Mad has said, with regards to savings accounts, having used multiple providers over the years, would you say to close the lowest amounts or to keep them open to grab the interest rates if they go up? Interesting question there, actually. So I suppose this is the idea that, would you not be able to go back to an account? Would it be closed to you? There aren't many of these ones out there. There are some accounts right now which are only open to existing customers. So if you already had an account with that building society or that lender, that bank, whoever it is, before a certain date, then maybe you can open up a regular saver with them at a higher rate. And one of them, I'm not sure which building society this is off the top of my head, but I think you get 3.5%, which is fantastic, but you had to have an account with them before Christmas. So it might be worth, if you've got some of these laying around, just to have them if they're likely to do something along those lines. But other accounts, let's say Marcus, for example, and a lot of you would have had a Marcus account when they first opened because they were market leading. They were one of the best easy access accounts out there. Gradually that dropped down to, it was 0.4% just a few weeks ago. Now it's up to 0.5%, and everyone can get that 0.5%, even if you're an existing or a new customer or an ex-customer. So I wouldn't worry about that one too much. But it's definitely worth considering if you think there's a chance of there being exclusive rates for previous customers. You got it there, then you're already in that mix. Copper Robbo, another question. My wife has told me that in the past that Virgin have had their issues and are untrustworthy. Can you shed any light on their rep now? I would say they're perfectly fine. I've got no issues with them. I've got accounts with them for my current account. I've had previous accounts with them in the past for other sort of savings before that current account came to play. And also, remember, they have merged with Yorkshire Bank and Clydesdale Bank, which again have had very, very decent reputations in the past. And they've just used the Virgin Money brand to bring it all together. So I would say there's no real reason not to use them over any of the other banks. I mean, let's face it, a lot of the banks, if you really delve into it, are going to have practices we're not massively fans of as individuals, but I wouldn't say they're untrustworthy. You may have had a personal experience with them, and that's always really important to consider. You might have friends who've had bad personal experiences with particular banks, and that's really, really important to take that into account. But with anything, whether it's banks, broadband, mobile phone, whoever it might be, you will have people who absolutely have a perfect experience, really good customer service, and other people who have a bad customer service. And it's very, very difficult to say this company is particularly bad, this one is particularly good, although there are obviously going to be some which are much, much better on the whole and some which are much, much worse on the whole. American Express, for example, generally has really, really, really good customer service. First Direct has traditionally had very, very, very good customer service, but during the pandemic, a lot of people have been finding that's deteriorated. It's a lot worse than it used to be. Whereas there will be some institutions, some places, which are just generally bad. You can't get through on the phone, you can't get the service you want, things don't work or whatever, whether it's banks or build or broadband, whatever it might be. So I would say don't worry too much about that unless you've had a real personal experience there, which might sort of colour your decision to go with them. What else we got here? So Blue Flower Ninja just come back on the health insurance question, asking how much am I covering and do I have any limits? Again, I say it's all individual. It comes down to your personal medical history. There'll be things that might boost it up if you've had things happen to you in the past. There will be limits based on which one you go for. So again, you have to kind of have a look and get those quotes yourself. It doesn't matter what someone else has got. You have to look for yourself. Probably very similar with pet insurance, really, isn't it? We've got Eve. We've got the Life and Times of Bob. We've got John. We've got Paul. We've got Sanal. We've got Flat. We've got Tyron. We've got Ed. We've got DL. We've got Colsey. Nice to see you guys join me. So now, can you give some colour on investment avenue of ISA? So very, very quickly here, this is if you're not across these things, if there's something you're not so aware of with the ISAs. As I mentioned before, you have a £20,000 annual allowance for ISAs. This is for a financial year, so from 6th of April until the 5th of April the following year, and then the allowance restarts. Now within that ISA allowance, you can choose between 4 different ISAs, and you can mix and match to any amount. You could have £20,000 in a cash ISA, or you could have 50-50, 10,000 in a cash ISA, 10,000 in a investment ISA, or a stocks and shares ISA as it's sometimes known. And similarly with the innovative finance ISA, which is basically peer-to-peer lending, which is generally regarded as a bit risky and probably not worth looking into, but it's up to you if you want to do more investigation there. The only one that's slightly different there is a lifetime ISA, which can be cash or it can be stocks and shares. That has a £4,000 annual limit, so that will come out of your 20k, leaving you 16k for the other things if you had the full 4k. But obviously you can have 1k there and mix it around as you wish. What you get with an ISA if you are investing is the money that goes into there. Obviously it can go up in value, it can go down in value, but any gains you make if you were to sell those stocks and shares or bonds or whatever you might have in there, that would be tax-free, so you wouldn't have to pay anything on that. Now, if you do have these outside of an ISA, these investments, in something called a general investment account, you lose that tax-free protection, but you also have an allowance, 2 allowances which are worth considering. One is your capital gains allowance, which is just over 12 grand, and you have a dividend allowance, which is £2,000 a year. So you actually, depending on how much money you've got in there, you still doesn't necessarily mean just because it's not in an ISA that you will be taxed on it. But obviously, the more money you have in there, again, this is on the gains you make, not the money, the gains you make. Though when I talk about those allowances, it's important to sort of make sure you understand exactly what the consequences of that would be, and again, talk about the fees and the platforms that go into it. So I hope that gives you kind of a basic intro there. Minimad has come back on the question on credit cards. How many credit cards should a person have? I have 3 at the moment and would like to get rid of 1. No balance on any of them. So this is a really interesting question around credit cards, and lots of people wonder, with old credit cards, what should you do with them? Should you get rid of them? And the answer is not clear, right? Because again, it comes down to individual purposes. There are certain things with credit cards. So one of them you need to think about is your credit utilization. And this is how much credit you have available to you and how much of that you have used. Now, the general rule of thumb from the credit reference agency, so Experian, Equifax, and TransUnion, is they'll say you will help your credit report and ultimately your credit score as a result of that if you have around 25-30% credit utilization at any time. So it's showing you're using them, but you're not going crazy. But at the same time, you're not having too little use of it and suddenly you could go and spend all this money that's out there. So that's generally where that comes from. Now, if you were to cancel a card you're not using, that could affect your credit utilization. It could suddenly mean that across all those cards where you were using a lower amount, all of a sudden it pushes it all up. So that's worth thinking about. It could also be a one you've had for a long time. So that would reduce the average length you've had with accounts, and credit reports like to see that you've been with certain institutions for a long time as well. It shows some stability. So there are reasons not to get rid of old cards you don't use. But on the other side, remember I mentioned just now that they don't like you having access to too much credit in case you go crazy and you're spending on it. Getting rid of one might reduce that risk. So if you were to apply for something else later on, they'd say, well, actually, yeah, because this isn't giving them too much credit. So I'm afraid I can't give you a cut and dried answer there. I guess have a look at your credit report scores. You can do that for free, won't cost you anything. I've got a whole video on YouTube and an article on the blog which will take you through how to do that and not be charged at all to check your scores. And if it's looking pretty healthy, if it's looking pretty good, then you're not really going to miss out by cancelling one of those cards at all. I would say you'll build it back over time. But unfortunately, there's no sort of clear cut and dried answer there. Right, I appreciate I've still got a fair bit to get through, guys. So what I'm going to try and do now is race through these ones we've got as well. Tyron said, how are your premium bonds going? So I didn't win again for another month now. So I had first month, no win, second month win, third month win, fourth month, no win, fifth month, no win. So at the moment, I'm still on course to get an average return for average luck because we're only sort of halfway through the year. but obviously I'd have to repeat that over the next 6 months to actually come back with that initial rate. So fingers crossed that will happen. No big wins. I mean, if I got the £1 million, would I still be here? I probably would. I love doing this. I'd still be talking to you. I might take some time out, but anyway, I haven't got £1 million from the premium bonds. Ross has asked, and this is a question you guys always asking me and keep asking me, but don't worry, I will let you know as soon as I know. Any idea on when Chase Bank is open in the UK? No. But as soon as I know, I will tell you. I will make a video. I will look when I know it's happening. I will put it in my monthly bank account update, news and update, which I always do at the start of the month. So you'll get that on YouTube. Hit subscribe if you haven't already to get that. And you'll get the information. And as soon as it's open and I've got my hands on one and I've got it, open the app, I will do a review so you know exactly what's going on with that account. But so sadly, nothing right now on that. Ryan's got a question about investing, so I'm not going to answer that one now for you. So because again, it's not really my expertise to sort of go into those details there. But you will be able to find answers to that, I'm sure, online. Andrew says, I just got my Amex and loving my cashback. Thank you for your help and advice. No, that's a pleasure. Great to sort of, that's why I do this. So you guys can, make the most of your money, whether that's saving money or making money or just better understanding it. So I'm really happy to do that. And Ryan has said, yeah, his Amex is amazing. He had Lloyd's credit card for years and years and got nothing out of it. But obviously now with Amex, he is. So yeah, well worth looking at. And I'm going to do something soon about the best Amex because those rate cuts for the Amex Platinum Cashback and the Amex Platinum Everyday Cashback are coming in the next few weeks. So I will have a kind of revisit on all the cards to help you know which one is best. So I don't know how to say this. CAXCVI says, hi Andy, what are your thoughts on the NatWest Reward credit card? 1% supermarket cashback. Already have a rewards current account, so no annual fee. Yeah, so this one pops up a few times when I do my savings videos or savings articles, so credit card articles and credit card videos. This is a card which will give you 1% as the question says at the supermarket, and it will give you 0.25% everywhere else. So it's not a bad card at all. You do have to have a NatWest Rewards account to not get charged the fee, but that's not a bad account to have necessarily. You can get some free money every week if you have some direct every month if you have some direct debits, and you can also get access to a regular saver that pays 3.04% interest, but only on 50 quid a month up to £1,000 in total. So lots of good reasons to have those, and if you've got that, to go for the credit card. Now, the reason it's never been one of my top picks before is you can get 1% with an Amex, which will give you that pretty much everywhere. So why would you need this NatWest card if you could get that 1% with the Amex? That's something that I will take into account when I look at the Amex rates dropping, because it could be that you have this card for your supermarket shopping. If you regularly shop at a Tesco, that will give you 1% back on your shopping as well as your club card points. That would be better than Tesco's own credit card. However, everywhere else that takes an Amex, you'd be better off with an Amex. So I will look into that again in more detail pretty soon. Adam says, Andy, having done without a credit card for the last 9 years, my credit file is solid. 999 Experian with other ones. So yeah, so that's great. If you don't need a credit card for this, but I think a lot of people, the reason they want to look at a credit card, and I get a lot of questions about this as well, is trying to help build up their credit score. People who have got what's called a thin credit report, a thin credit file, because they've got no history. There's nothing there to sort of show that they have any responsibility with it. But if you've got all loads of other things and you've got a history of doing this, you might have a mortgage, you might have phones, broadbands, all those kind of things going along, which give you that score and boost it up, then the credit cards aren't so important. Obviously, over time, it might find those sort of dips if it hasn't got evidence that you are borrowing. But yeah, you absolutely do not need to have a credit card if you aren't comfortable with them and you don't necessarily think you're going to be able to use one without it causing you problems. And if that's the case for a lot of people, that is the most important thing. You want to avoid debt. You don't want to get one of these and spend on it. And I'm not saying that Adam would do that, but I know for a lot of you that might be the case. Let me just check what's going on Instagram, if there's anything I've missed here. Hi to Uncle Johnny and Paris and Flanners. Great to have you guys join me. Right. Let's have a look. I think that's pretty much it then. I think I've got everyone's questions. One here from Copper and Robbo, another one from Copper and Robbo. Let's do this one before we go. My Flex Direct account with Nationwide is due to end its interest for me in August. Can you haggle with the banks, etc., and threaten to leave them to get a better deal with them? So yeah, this is a good one for us to talk about. The Flex Direct current account is for the first 12 months when you open it, if you're new to it, if you've had it before, you won't get this. You would get a rate of interest for 12 months. So this used to be 5%, but bit by bit it's dropped down. And now it offers 2%. That's what you get on the first 1.5 grand you have saved. When that ends, it ends. Well, actually, it drops down to 0.25% for first grand and a half. You can beat that elsewhere. You won't be able to haggle a better rate with them. So I would say if you can open up an extra savings account elsewhere if you want and just move your money there. It doesn't have to stay in that Nationwide account. If you don't want to stay with Nationwide, you can use it and you can switch to another one. Get one of those switching bonuses that are around. Again, loads more details about those on the website and on the YouTube channel. So again, you don't have to stick with them at all for that, but you won't be able to get a better deal. It's not like, unfortunately, your energy or your broadband where you can, well, not your energy, but your broadband where you can sometimes haggle that as well. I think that's probably all we've got time for, guys. Let's just see what we've got. Anything else we do quickly? No, I think probably haven't got enough time to do those rest other ones. Thank you so much, everyone. I'll be back this time next Tuesday. So 7 p.m. Tuesday, the 27th of July for the next one of these on YouTube and on Instagram. So thank you so much for tuning in. If you came into this late, don't worry, you'll be able to watch it all again on replay. So do that. And I think, yeah, enjoy the heat and the sunshine while we've still got it, right? Yeah? All right, guys. Thank you so much. And I will see you guys again soon.